Every investor remembers one thing, their first investment, whether it was a mutual fund, a stock, or a simple SIP. That first step wasn't just about putting money into the market, it was about believing in the future. And today, taking that first step has never been easier. With just a smartphone, anyone can open a demat account, start an SIP, or buy their first stock in the matter of minutes. But while investing has become more accessible, building wealth still requires the same timeless principles: patience, discipline, and informed decisions. Now, where should a first-time investor begin? Is an SIP the safest starting point? Should you invest in stocks or mutual funds? How much risk is too much? And what are the common mistakes that can derail your financial journey before it begins? So today we'll answer all these questions and we'll help you understand how you can take one step at a time into investing with confidence and clarity. This is the show, The Money Show. I'm with you, Kavita Thapliyal, and once again we'll flash our QR code so that you can scan it and send across your question, because this is the show where we answer all your portfolio related queries as well. We do your life financial planning. Just send across the details of your current investment and we will have it analyzed by our experts and help you align your investment strategies with all your financial goals. But let's begin with something very important. India's market regulator is doubling down on the newly launched CAS framework. Despite mounting backlash from traders over low liquidity and wild closing prices, SEBI chairperson Tuin Kanta Pandey officially confirmed that the regulator has found zero evidence of price manipulation, has no plans to alter or discontinue the mechanism. The reform, which rolled out earlier this month, completely restructures how the closing prices of 208 FNO eligible stocks are calculated. So first, let's listen in to what the SEBI chairperson has to say.
कि जो कैश है वो एक बहुत बड़ा माइक्रो स्ट्रक्चर रिफॉर्म है और हम लोग एक्चुअली पीछे रहे हैं। बहुत सारे जो ऑल ग्लोबल हमारे काउंटर पार्ट्स हैं वो ऑलरेडी कर चुके हैं। सारे इंडिकेटर प्राइसेस किस प्राइसेस पे मैक्सिमम बिड्स कवर हो रहे हैं, सिर्फ ये कंसोलिडेट करता है को बिड्स, ताकि एक पर्टिकुलर बहुत ज़्यादा वो, और उसमें भी रैंडम क्लोज है, क्योंकि रैंडम क्लोज का मतलब है कि उसमें भी और संभावना है कि लास्ट मिनट कोई इस तरह के बिड इम्पैक्ट ना करे, इसलिए रैंडम क्लोज भी रखा है। अब पार्टिसिपेशन बढ़ाने की ज़रूरत है, अधिक से अधिक लोग उसको समझें। ब्रोकर्स में बहुत सारे ब्रोकर्स ने इंडिकेटिव प्राइसेस, जैसे आई थिंक मुझे लग रहा ज़ीरोदा है और या अपस्टॉक्स है, इन्होंने ऑलरेडी अपने वेब में किए हैं, ऐप्स में भी वो करेंगे।
All right, so that was SEBI chairperson, but then let's discuss all of this and also put the spotlight on the arbitrage funds. We are also joined by our expert panel, Feroze, Azeez, Sunil, Subramaniam, and Gaurik Shah. Hi, good evening and welcome all of you. We'll take this show one by one because the show is about CAS, it's about its impact on mutual funds, NAV, and specifically on arbitrage. But Sunil sir, I'll come to you first, because what according to you was the reason why SEBI chairperson had to give this clarification on manipulation of the prices? And in a nutshell, in a layman's language, if you could also explain our viewers about CAS.
So first of all, it's very simple. The existing system was something which in usual jargon terms of our industry was called VWAP. There's nothing but volume weighted average price, which meant that earlier, in the last half, earlier the closing price was based on the last half an hour of trading. And suppose I'm going to sell 1 lakh shares of a particular stock, right? And the price at which fix, I'm distorting the market because the volume that I am putting is given a undue advantage. So block deals will get executed in the last half an hour or distorting the prices. Now the world over, right, this has not been the system. The system is the closing auction system. CAS, nothing but closing auction system, where 3:15 p.m. now the trading stops, and in the next 20 minutes, right, there is the bids and offers which need to be given, and one equilibrium price is fixed. Now this is a far more transparent and system which is stabilized in the rest of the world and used. SEBI, as SEBI chairman said, we have been late in introducing. But when it was introduced, perhaps what happened was a trial period, a period of education, period of involvement was probably not done. It was with sufficient notice, but the actual participation was very low. Number of people were still uncertain about it. That was one of the cause of the problem. So if you see the first 3 days after cash was introduced, in the last 15 minutes of trading, the markets shot up, okay, because of the price differences. The second is that there was a big disparity between the Sensex year return for the day and the Nifty 50, when both are essentially large cap indices. And this was because of very low participation. The second problem which this created was that there is the arbitrage system. That is, there is the derivatives market also. That is still continuing on a volume weighted average price basis with a closing after this. So a lot of the arbitrage funds, which we'll come to in detail probably later, but because of the timing difference, right, this price spike meant that arbitrage funds showed a huge return on the first 2-3 days. So people got very worried about it. Some people said, oh, what is this? Some people trying to take advantage. So I think that to summarize it, I think the cash is a much more prevalent developed market system brought to India. After the first 3 days, it has now stabilized. Participants have started doing, mutual funds have started doing. But initially, what had happened was the mutual funds, especially, all were trying to close out all their action before 3:15 so that they're not subject to this last minute volatility. But as an investor, the mutual fund NAV is still calculated on the closing price. So a lot of customers have also started saying that, look, the fund has to redeem at the closing NAV, but he may not have realized that price to refund it. So the existing unit holders are getting affected. So there is still a significant degree of confusion in the minds of investors about this, but
Absolutely.
I'm sure SEBI chairman's clarification, as participation also goes up with participants, more participants putting in bids during that window, it will stabilize.
Absolutely. All right. So before I go to Feroze and Gaurik, this is something for the retail investors or our viewers to understand. So while retail investors have expressed deep frustration over erratic daily price divergence, institutional players are moving in fast. Now, SEBI reveals the mutual fund participation in the 20-minute closing window has surged from a mere 7% to nearly 25%. Now, as fund managers use the session to calculate NAVs. Now, to bridge the transparency a gap for retail traders, the regulator is now actively pushing major stockbrokers to integrate indicative closing prices directly into the trading apps. SEBI maintains that replacing the old 30-minute average price system aligns India with global giants like the New York and London Stock Exchange, ultimately protecting the market from the last-minute order manipulation. Now, if you track mutual funds, you know the arbitrage funds are usually the most boring and predictable part of your portfolio. They are the safe haven where you park cash to earn a steady 6 to 7% a year. But what we saw earlier when the CS was introduced, the boring turned into a blockbuster. Why? Because following the notification by SEBI and NSE's rollout of new closing auction session, on 3rd August, arbitrage fund NAVs didn't just move, they exploded. On day one, we saw single day jump of nearly 0.5%, translating to a wild annualized yield of over 160%. But by day 2 and day 3, those gains began evaporating just as fast as they appeared. Now, this is the biggest operational overhauls with the implementation of CAS for F&O stocks. While the headlines promised a system that prevents last-minute price manipulation and reduces tracking errors for ETF, the reality on the ground has triggered a massive unintended side effect. It has thrown arbitrage funds into a state of severe price distortion because normal cash trading now abruptly stops at 3:15 p.m. to move into an auction pool. The final hour has seen the traditional cash to futures spreads widen violently. While proprietary trading desks are insulated, retail investors are waking up to erratic, volatile swings in their daily NAVs. Now, is this just a temporary teething issue as the market discovers equilibrium, or has CES fundamentally rewritten the risk-return playbook of the 3 lakh crore arbitrage fund category? Let's discuss this with Feroze now. Feroze, a quick take on arbitrage fund and the price volatility that we've been seeing since 3rd August now.
The arbitrage funds, the volatility was momentary, in my judgment. If you're buying an arbitrage fund, if you buy it from expiry to expiry, the volatility is going to be near zero. Today, the forward rates, which is what arbitrage derives its expected return from are between 6.1% for as much as December straight rollover of synthetic futures. What does this imply? It implies that if the screen price of synthetic futures of December is 6.1% and a rollover to September, we have the next expiry, the 25th expiry is the last expiry for August. And then you have 4-week month of September. If the forward rate is 6.3%, if you've bought it on 25th of August and sold it on exactly the expiry of September, it's unlikely that a fund manager will not be able to realize plus or minus 30 bips from there. That's one. Two, of course, when the cash system was applied, there were 0.5% rises, but the subsequent day, the markets corrected. But the inefficiency corrected naturally because, of course, one of the days Sensex underperformed and outperformed Nifty. The subsequent day, it underperformed Nifty. But I think, of course, that got corrected because the closing price in the cash of BSE didn't have so much impact. But what is more important is, if you look at cash system, it is the smartest way to handle manipulation. If retail is upset, then who should not be upset? Because somebody who has a 10,000 crore notional derivative exposure can be upset because the kind of swing he's going to see is astronomical and he will not be able to change the prices. In fact, I've been very actively involved in derivatives. I'll tell you, you could have decided the closing price for most of the stocks if you had very deep pockets in India. So what would a fund manager, what would a large institution do, especially FI has done this, practically done this, is buy one rupee ke put options through the day, 10 crore put options khareed liye, 10 crore rupiya kharcha kar diya. That's step one. Then before, this is done before 2:33 in the morning. You've bought 10 crore put options, just paying 1 rupees. Then you go look at the top 5 stocks of Nifty, and in the cash market, sell, intraday, sell 100, 200, 500 crores of each of these stocks. You lose 100 crores in the cash market, but your 1 rupee put option, which you have spent 10 rupees for, 10 crore rupees for, suddenly becomes 50 rupees. So you made 500 crores there, you lost 100 crores here. Net, you made 400 crores. Quite a few people wrongly said this was fat finger. डीलर की मिस्टेक से 100 करोड़ का नुकसान हुआ, डीलर की मिस्टेक से नहीं, एल्गोरिथम ने इंटेंशनली यहां 100 करोड़ का नुकसान किया ताकि you can make 500 crores in the derivative market. If the regulator sees this and keeps quiet, then everybody is upset with the regulator. The regulator sees this and gives a medicine. They say, why is the medicine not so tasty? Give me which one medicine which is tasty. Medicines will take its time. You have to administer it. And the retail is what it's being solved for. If 90,000 crore plus is lost by retail, this solves their problem and it solves passive's problem. Like the chairperson said, passive is 30% of FII ownership is passive, and they find it very difficult to execute on the review dates. There are 4 review dates, 4 review months largely. August, November, February, and May are review dates for MSCI, and August is a review date where we expect some India weightage higher. So I'm very happy that the FII should be happy that passive ownership will get better price discovery on review dates.
All right. Gaurik, now from you, I want to understand, the managing the execution part and maybe tracking the risk from a fund manager's point of view. Now, under the old 30-minute VWP, system, we had a smooth window to execute and match prices. Now, with a pure auction block, how are the trades being managed in terms of execution of the risk? Is one really forced to leave money on the table, or changing or rolling over the situation is an option? How is it managed? How do you manage the risk?
Still, see, currently it's early days. First couple of days, I think there was some volatility around the closing prices, but after that, it has substantially settled down. And the difference between 3:15 p.m. reference price and the final closing price is within that manageable limit, or the limit which was also there earlier. Having said that, from the point of view arbitrage fund, I think a basic fundamental of arbitrage fund is you should be able to trade your cash and the futures leg together. So the typical difference would be in the microseconds between we will be executing a cash leg and a futures leg. Now that is currently bit difficult within the cash because that 315 to 330 period where the cash is in the auction, you don't know how much volume is going to go through. And then if you are able to trade in that in a cash market, then in the futures market, you may have certain, leftover positions there. So it was difficult to trade between 315 to 330 or being participate in the cash system for the arbitrage fund. Having said that, the basic thesis remains the same. Your returns are more or less going to be in the similar lines what earlier Mr. Azeez said. So it has not changed. Your spreads have remained stable. You are still should expect over a period of time the similar returns what you have been generating. What has changed earlier was the volatility in that 1 or 2 days where that cash price was marked up substantially on the first day, 3rd August, I think on the 4th August, it was the same case, where returns momentarily NAV were marked higher, but that was not a tradable gap. So no one would be able to take advantage of it as such because no one knew at, let's say, 315 that this price is going to be marked up or down. So that spread immediately came down at 9:15 when the next day market opened. It immediately came down. So your overall spread has been stable. So overall return for arbitrage fund is going to remain more or less same.
Okay.
What might change is that volatility around that rebalance days is something which might subside in this thing, but this is still early days. Volumes have still not picked up.
Right,
So we
right.
will wait and watch how that thing goes.
All
And
right. So
the system is here to stay, so it's okay.
all right, so we'll have to give it some time, but then it's time for a short break now. But then post that, we'll be discussing more on the capacity constraints and also the liquidity constraint that one might see in the arbitrage funds after this break. Welcome back, and you're watching the Money Show. We're having a discussion of the impact of CAS on arbitrage funds. Sunil, sir, I'll come to you now with this question. And does this new CAS mechanism restrict the size or capacity an arbitrage fund can deploy at the market close without severely impacting its own returns? Will large funds face a disadvantage compared to smaller, nimbler ones?
Not necessarily. I think the market has adjusted rapidly to it. It's the first 3 days we exclude. The arbitrage return, daily returns are back to normal. So the point is only that the difference in timing, there's still two things which are still there, which is the arbitrage, the derivative market still continues on VWAP and this is on the CAS. The second is the timing difference. So that could cause, but I don't see that, I've not seen any difference in returns between the large funds and the small funds in terms of the trades. My only worry is from a retail investor perspective that if he goes back and look at the arbitrage fund, even now, a 1 month return is showing something like 0.9 flat, which means on an annualized basis, it's about between 10.5 to 11%. This will disappear as it reaches the volatility, the expiry date, right? So people shouldn't get trapped and look at these 10% past returns and try and put money into arbitrage funds now saying it's going to be something that I will get in the future. So I think apart from that, I think the increasing adoption of the mutual fund managers and the algorithms to this, I think, is already stabilizing. So I don't see at this point of time much difference in terms of fund sizes playing a role at this point in time.
Right. Feroze, a quick question. So expiry to expiry is the timeline you recommend the investors to hold it?
Yes, Kavita, expiry to expiry to be on the safer side, but doesn't matter, 10, 20 bips here or there. The cash system will settle, point one. Point two, arbitrage fund guys don't change their cash holdings so easily. Because the bigger problem for an arbitrage fund is an STT. Today, if you see the Nifty 50 stocks and look at the forward rates or the forward premiums or future premiums, you will see one stock quoting at 12% premium, the other quoting at 2%. Then when you ask the fund manager, ये 2% से निकल के 12 में क्यों नहीं जाते हो? He will tell you STT will eat away most of this difference. So what does an arbitrage fund in the practical world do? Buys 30 stocks. He keeps those stocks as is, keeps shorting futures every month and rolls over those short positions. So would we have to participate in a cash system for 100% of his portfolio? The answer is no. The turnover of an arbitrage fund in the cash market is very low because he has a large STT to pay if he changes Reliance to HDFC or HDFC to ITC. Wherever he gets better arbitrage, he's still not able to go because STT will eat away the difference. So the bigger problem is the STT increase in this budget, which impacts the arbitrage fund return by 1%. STT itself is eating 1.3%. And in stock futures, I think we should also represent to the regulator that there has to be, if stock futures can be opened up for 9 months, 12 months, like short-term options are open for 9 months. So futures should also be open for 9 months so that an arbitrage fund does not have to roll over every 1 or 2 months. That will bring down STT. That's a bigger problem.
Right. Gaurik, I just have 30 seconds. So the safe haven label on the arbitrage fund is not broken. Is that right?
Absolutely, there's no difference. It's a business as usual for us. It's just that we have to be stopping at 315. Otherwise, capacity remains same, returns remain same, everything remains same. There's absolutely no change in terms of investment thesis of arbitrage fund.
All right, so I think that's the time we have on the Money Show today. But the big takeaway from our experts is very clear. Do not panic. The current daily jumps and drops in your arbitrage fund NAVs are just temporary teething troubles. The product is not broken. The core structural framework of arbitrage funds remains perfectly intact. Thank you so much, all three of you, for taking your time out and explaining all of this to our viewers today. Thank you so much. And with that, it's a wrap as well on the Money Show. Thank you so much for watching. Goodbye.